Today, many of us are wondering about how to properly invest our money so that we may earn even more income. Investments are the most common type of passive income that we might generate. However, investments always require that a bit of cost-benefit analysis that we all do. This balance, however, may range from YOLOing your entire savings into some Dogecoin to hedging investments on various index funds. It's always important for investors to invest in places where the amount of risk is lower, while also increasing income and retaining capital. As a result, today, we will look at the top 5 investments with the lowest level of risk. My name is Sam. Welcome to Deltatheta. Let's get started. If you want a higher interest rate than a savings account without taking on much more risk, government bonds are your best pick, with rates ranging from 2.46% for a 1-month term to 3.58% for a term of 30 years as of mid-September 2022. Treasury bonds, notes, and bills of exchange are debentures issued by the U.S. government. When you purchase them, you're effectively lending money to the government, which commits to repay you with interest. The U.S. Treasury notes are backed by the complete faith and confidence of the U.S. government. The United States has always fulfilled its obligations. This secures public debt and makes it simpler to acquire and sell on secondary markets if you need cash before the debt matures. The difference between bonds, notes, and bills is the term. Treasury bills are short-term securities with maturities ranging from 1 year to 3 years. When you purchase a Treasury bill, you are paying less than its face value. You obtain the face value when it matures at the end of the period. For example, a $100 Treasury bill may be purchased for $95. It matures after a year, and you receive $100. Treasury bonds and notes work a little differently. Treasury notes have maturities ranging from 2 to 10 years, whereas Treasury bonds have maturities of more than 10 years. They pay a fixed rate of interest twice a year and pay the face or par value at maturity. Just as the U.S. Treasury issues bonds to raise money, corporations also issue bonds. This option is for you if you are willing to take on more risk for higher returns. Highly rated corporate debt is a good option. After all, bonds issued by reputable, high-performing companies typically offer higher yields than Treasury bonds or money market accounts. As previously said, they are riskier than U.S. bonds since there's always the possibility of the firm going bankrupt. However, if this is the case, bondholders receive payments before shareholders, making corporate bonds less risky than stocks. Corporate bonds are issued with a face value, or the amount that the company must pay back. The face value is typically $1,000. However, the bond can be sold for more or less. Bonds also have a maturity date, which is the amount of time until the bond matures, and a coupon rate, which is the interest rate paid to the bondholder during the life of the bond. Every 6 months, interest is paid. A bond can be sold for more or less than its face value, but an investor can compare bonds by examining the yield to maturity. This is the yearly return on the bond's par value, assuming you hold it to maturity, and it is computed using a formula that considers the coupon rate, par value, purchase price, and maturity. According to the St. Louis Federal Reserve, the average interest rate of a 10-year high-quality bond is 4.57% as of August 2022. While highly rated corporate bonds are typically secure investments, you can still lose money if interest rates are rising. Because bond interest rates are normally fixed for a set length of time, your money will not receive a greater rate. If you need to sell your bonds, you could have to sell them for less than you paid for them if interest rates have risen. If you retain your bonds until they mature, you will get their face value plus interest. Although investment-grade bonds are typically seen as a pretty safe investment, they are not as secure as money in a bank. That is why it is critical to concentrate on debt issued by highly rated companies that are more likely to pay you back. Companies with a lower rating may offer higher interest rates, but you're also more likely to lose money if you do business with them. A fixed annuity is basically a one-off payment to a financial institution who will then pay the amount back to you in equal monthly payments plus interest. The interesting thing here is that they can be signed for life, making them ideal for pensioners who have a pool of savings, but one that won't likely be enough to sustain them indefinitely. An annuity is defined by the Securities and Exchange Commission as a contract between you and an insurance company in which you make a single payment or a series of payments, and the insurance company agrees to make periodic payments to you, beginning immediately or at some future date, and continuing for a specified period of time. A period of time, for example, could be 10 years, 20 years, or your life. A fixed annuity has a fixed interest rate, and the issuer is required to pay you at least that rate for as long as your account is growing. The magnitude and frequency of payments are likewise predetermined. The interest and payment amounts specified in your agreement are guaranteed as long as you hold the annuity to maturity. Fixed-rate annuities are the lowest risk type of annuity, hence their returns are often the lowest. However, if the issuer's investment performs better than projected, you may receive more than that minimum. If they don't, the insurance will reimburse the losses. In any case, annuities provide a predictable, guaranteed income during retirement with little or no risk of loss. Fixed annuities function similarly to certificates of deposit in that you agree to lock up access to your money for a specified length of time in exchange for an above-average interest rate. 10-year fixed annuity rates are approximately 4.75% as of mid-September 2022. However, keep in mind that higher interest rates are sometimes offered by not-so-reputable insurers, implying that they are more likely to fail on a payment. Remember that penalties may apply if you need to access all of your money before the fixed annuity's due date. However, you usually have free access to a portion of your money each month. Also, at the moment, many investors are attracted to the market of cryptocurrencies, which may also function as a reliable investment for you. In April 2021, Coinbase Global, the main cryptocurrency trading exchange, held an initial public offering, or IPO, meaning you can now purchase its shares. The company is a well-known platform for purchasing key cryptocurrencies, including Bitcoin, Ethereum, and Cardano, crypto ADA. It also lets users trade over 160 different altcoins. Coinbase's success was dependent on the rise in cryptocurrency prices, which resulted in millions of additional customers opening accounts. Every time someone puts in an order to purchase or sell cryptocurrency, Coinbase receives a small transaction fee. However, the firm intends to be more than just a trading platform. It also sponsors a debit card that allows consumers to spend money from their digital wallets, and has established a cloud platform for businesses that use and hold digital currencies. Coinbase offers two groundbreaking innovations. First, it's bringing to the masses the practice of lending against assets, which was previously available only to wealthy investors. Users can use bitcoins or other cryptocurrencies as collateral to get a low-interest loan to meet expenditures. Using cryptocurrencies as collateral eliminates the need for investors to liquidate their assets in case of an emergency, enabling their principal to accrue while they address present difficulties. The second innovation is the increasing use of Coinbase blockchain analytics by governments and financial institutions. Due to the fact that most blockchains run on a public ledger, a company may utilize the data to track illegal transactions and wallet addresses. Suppose hackers get access to a person's computer and want a Bitcoin ransom in order to unlock the system. In this situation, Coinbase may use its platform's millions of Know Your Customer (KYC) data points to match the hacker's wallet address. This might assist law enforcement in tracking the movement of funds and apprehending crooks. Hence, increasing trust in the cryptocurrency space. Cardano is an open-source project aimed at developing a system for running financial applications. Its own currency is ADA, which serves as network digital cash. Cardano's methodology distinguishes it from other cryptocurrencies. Cardano builds its system in a scientific and rigorous manner, a peer-reviewed system. This means that every protocol and technological innovation they develop must be quality tested by world-class technology experts. Why? Because the team needs the back end of their platform to be built with high reliability code, which is crucial. This is the same level of programming utilized by engineers when developing airplanes. Aircraft software. See how methodical and careful their approach is? To top it off, Cardano is run by Charles Hoskinson, the co-founder of two successful cryptocurrency projects, Ethereum and BitShares. So, relatively, your money is in safe hands. I consider it a low-risk investment. So, that's our top 5. There's not one that's better than the other per se, rather, each is suited to a certain kind of investor. To understand what kind of investor you are, it's good to analyze 3 things. First of all, it's critical to understand how long you're willing to invest your money. Some prefer short-term investment because it reduces risk. However, long-term investing allows you to take a bit more risk, hoping that time will work in your favor. The fixed income generated by low-risk assets can be paid out in a variety of ways. They can, for example, be paid yearly, quarterly, daily, or at the end of the term. Consider how revenue is distributed on a certain investing platform and which style works for you. Also, think about whether you are a passive or active investor. You must decide how much time you are willing to devote to portfolio management. The main thing to consider here is whether you like to dollar cost average to keep things simple, or whether you prefer to spend loads of time hunting for the best interest rates or exploring various index or bond funds to invest in. But, as a few final words, remember, the ideal low-risk investment for you is one that allows you to sleep at night. If you're lying awake at night, worried about losing money, it's time to shift your focus to lower-risk investments. Analyze each source of income carefully and select the one that best suits you. Remember, whoever does not take chances does not enjoy champagne.